If you want to almost guarantee you get approved, there are 5 things you need to have dialed in between the day you get your pre-approval and the day you actually close. My name is Francisco, and I've closed over 400 loans and approved over 200 million in mortgage financing. And what I've learned is that most pre-approvals don't die because the borrower wasn't qualified, but because of something that happened after the bank said yes. You see, pre-approval isn't approval. You aren't actually approved until the day you get the keys. And between those 2 moments, there are 5 things every lender rechecks on your file, and if any of one of them has changed, the deal goes with it. So whether you've already got a pre-approval in your hands or you're about to get one, today I'm walking you through the exact 5 things I check on every file after the bank says yes, so you know what to watch for, what to fix, and what kills a deal that was already approved. So let's start with the first one. And it's a check most borrowers don't even realize is still happening after the bank said yes. Because your pre-approval is based on the credit report, pulled the day you applied. But most lenders repull one more time within 3 to 7 days of closing. And whatever shows up on that second pull gets recalculated against your original file, which means a new Pottery Barn store card, a balance spike that pushes your minimum payment, let's say $40 higher, or a single missed payment is enough to take a file that was perfectly approved on Monday and bring it back to denied on Thursday. I had a client whose credit actually moved the other way during processing, from a 660 to a 708, because we had built a rapid rescore plan for this client before we submitted. That kind of movement works in both directions, and the repull is what catches whatever moved. So from the day you sign your pre-approval letter to the day you get the keys, your credit report is frozen. Any new credit application, balance run-up, new inquiry, or cosign is gonna show on that second pull. So you stay off all of it until the keys are actually in your hand. So treat your credit report like somebody is refreshing it on a screen every single morning, because a week before closing, somebody actually is. But your credit report isn't the only part of your file that gets fresh eyes before funding, because the second thing the lender's gonna recheck is every deposit that hit your account between the day you applied and the day you actually close. Before funding, the lender pulls your most recent bank statements one more time, looking for 2 things. The cash you said you had is still there, and every new dollar that shows up since the last pull can be explained with a paper trail. If a deposit doesn't match a pay stub or a 1099 or another documentable source, it becomes what the industry calls an unsourced deposit. And unsourced deposits can't be counted towards your down payment or your reserves. I had a client with a $5 million condo in Fisher Island who needed $1.5 million in a cash out refi. 2 lenders had already denied her because her bank statements showed $124,000 a month coming from the Dominican Republic, and no underwriter wanted to touch foreign deposits they couldn't cleanly trace. So we pivoted her off a bank statement loan and put her into a P&L loan, had her CPA formally certify her income, and bypass the deposit issue entirely. That's the level of scrutiny underwriters bring to deposits, both when you apply and when they pull your statements again right before funding. And the killers aren't always the big numbers. A Venmo from a family member without a gift letter, or a couple thousand in cash you deposited without a paper trail, it can count as unsourced. And unsourced money either shrinks what you bring to the closing table or blows up the file entirely, which is why every dollar moving into your account between now and closing needs a paper trail right behind it. A gift from a family member needs a proper gift letter and enough time to season. Cash has to go in at least 60 days before the statement pull. And anything you can't trace yourself, you don't move until you've talked to your broker. Now, credit and deposits are just the paperwork side of the file. But the third check goes one step beyond your paperwork entirely. And within 7 to 10 days of closing, most lenders call your employer directly to verbally confirm you're still employed in the same role and in the same pay. It's called the verbal VOE, or verification of employment. And every lender I work with does it. And this is where a lot of buyers get into trouble, because they assume that as long as they're still making the same money, they're fine. So they take a better job that pays more, they switch from W-2 to 1099, or they accept a 2-week unpaid vacation to help family. And any one of these, even when it looks like an improvement on paper, can kill the file the day before closing, because your underwriting was done against a specific job. And once you change that job, the approval doesn't carry. If you switch from $120,000 W-2 to $140,000 1099 contract, you just didn't change employers, but also income classifications. The lender now has to treat you as a self-employed, which means they need 2 years of tax returns on the new income, which you don't have. And the deal dies on the spot. So the job you had on pre-approval day is a job you have on closing day. And that means keeping the same employer, title, and pay structure, exactly as they were when we submitted. If something at work is about to change, you call your broker before you agree to anything, because one conversation on Monday can save you a dead deal on Wednesday. And by the way, if you already have a pre-approval in your hands and you want somebody to pressure test it before you go under contract, I'll leave a link in the description below where you can book a free consultation with our team of experts. We'll pull your file, walk through your credit, your deposits, and your employment situation together. We'll flag every risk that's likely to blow up between now and closing, so you can get ahead of it before the lender does. Now, those first 3 checks are all about managing your own file between pre-approval and closing. But the 4th check is about something you don't directly control, and that's the house itself. Because once you go under contract, the lender orders an appraisal to confirm the home is actually worth what you offer. And this is the one check on this list you have the least control over. If the appraisal comes in at or above your price, the loan moves forward clean. And if it comes in below, the lender only lends against the lower number, the appraisal. So if you went under contract at $500,000 and the appraisal comes in at $480,000, the bank only funds on $480,000, and that $20,000 gap is coming out of your pocket, or the deal renegotiates or the deal dies. In a hot market with over asking offers, appraisal gaps of $20,000 to $50,000 are not unusual, and the buyers who get blindsided are the ones who sign an aggressive contract without running their own comps first, which is why before you sign anything, you pull the last 90 days of closed comparable sales on the same street or in the same building. And I mean actual closed sales, not the Zillow estimate. Because if your offer is more than 3 to 5% above the highest recent comp, you're taking a huge risk on the appraisal. And you need to know before you sign whether you can bring the cash to bridge the gap if it comes back low. But clearing the appraisal isn't the end game either, because the final stretch before closing is where a lot of already approved deals still quietly die. And that brings me back to the 5th check, which is on the last 72 hours before you actually close. These are the hours where most buyers finally relax because they think the deal is essentially done. But then it turns out that this is the most fragile window of the entire process. See, by federal rule, your lender issues a document called the closing disclosure, or CD, 3 business days before your closing date. Once you receive it, there's a legally required 3-day waiting period before you can actually close. And that window exists to protect you from last-minute surprises on fees and terms, but it also exists for the lender, because during those 72 hours, most lenders run one final soft verification, the final check. They run one more credit check, sweep through your accounts just one more time, and confirm your employment again. And anything that has changed in the last 2 weeks gets caught right there. Whether it's a $5,000 hot tub charged to a new credit card, or a $15,000 transfer between accounts without any explanation, or delayed paycheck that trips the final VOE, any change significant enough to affect the loan terms triggers a new 3-day CD reset, which means your closing delays, your lock might expire, and your seller gets nervous, and the whole deal goes back to the table. So from the moment you receive that CD to the moment you sign the closing papers, you treat the deal like the bank hasn't actually said yes yet. That means nothing new on the credit, no moving money between accounts without a paper traced reason, and no celebrating spending until the wire actually hits. Because technically, until that wire hits, the seller's account and the keys are in your hand, they haven't said yes yet. Which brings me to the question that actually matters once you have a pre-approval in your hands. How many of these 5 checks has anyone actually run on your file? Because for most buyers, the honest answer is 0. Their bank handed them a letter, told them they were good to start shopping, and sent them on their way. And nobody on that side of the desk is actively watching for what's going to show up on the repo, tracking the deposit history, or flagging the VOE landmines before those land on closing week. And I know this because that's what we do every day at Vantage Mortgage. We've closed over 150 loans for clients who were denied somewhere else, told to wait, or lost a deal at the closing table because their last lender wasn't watching any of this. So if you already have a pre-approval in your hands and you want somebody to actually run it against the list you just watched, or you're about to get one and you want a broker who manages the file all the way through funding, I'll leave a link in the description below where you can book a free consultation with our team. We'll pull your current file, run it against every one of these 5 checks, and tell you exactly where the risks are, so you can fix them before the lender catches them on the final pull. So go below, book the consultation, and let's get your file into the shape that actually makes it to the closing table.